Module 42 is our last economic model. We're going to learn about the foreign exchange market, which is shortened to the Forex model. This is all about currency exchanges. So as you can see in this model here, it's a supply and demand model, but it's supply and demand of one currency, in this case US dollars, and the price of the currency is how much of another currency you would have to pay to exchange and get one US dollar. So we can see the exchange rate is the price, and that is in euros per dollar. This could be in any other foreign currency. 95 euros, and that's the symbol for euro, will buy you one US dollar. So we can see supply of US dollars, demand of US dollars, and quantity of US dollars. It is important to keep in mind that the dollar is not only used in America. Many other countries have a currency of their own that happens to be called a dollar, but it's not the same as ours. So you can shorten this to supply of USD, but just doing the dollar sign icon, this dollar symbol, will not be enough. We have to specify US dollars. And then just look at some other symbols here. We have the dollar, this is the pound, euro, yen. If you know any of these currency symbols, you may use them. So you can see here how we have the euro symbol for the price. Now, if you didn't know the symbol offhand, you would just write 0.95 and then spell out euro, and that would be totally fine as well. In Module 41, we learned about the balance of payment accounts. And there's two major categories within this balance of payments. So CFA stands for capital and financial accounts. If you recall, these are assets. If they're officially purchased, that means that they're bought by the government or the central bank. If anyone else, a person or a business, buys the asset, that would be a privately traded asset. But all of those would be part of CFA. The other major category is current account, which is abbreviated to CA. This includes goods and services, transfers amongst family members, and factor income. And our rule is that one is equal to the inverse of the other. So if one has a surplus, the other one has a deficit, and vice versa. Now, something that actually makes sure that these two things really are balanced is the exchange rate. So things affect supply and demand of your currency. And if the value of your currency goes up, that's called appreciating. And that affects the prices of things for anybody else in the world who wants to use your currency to buy your products. So the exchange rate determined in the Forex market will help to balance the balance of payments accounts that we saw in 41. So there is a link between these two. If you've traveled to another country, you've probably converted your currency into a foreign currency. But sometimes people haven't traveled or just have a hard time relating to this concept. So you can think of currency as tokens that you would need at an arcade. So normally at arcades, you can't pay in cash. You need to convert your money into some sort of other thing that they will accept. So you take your money and you buy tokens. So let's say that the exchange rate is $1 equals 4 tokens. That can go the other way around as well. That means that one token equals 25 cents. So we would just divide both sides by 4 to get that number. So the point is that exchange rates can go either direction. They're really just a ratio. And that's how we do it. All right. So if $1 buys 4 tokens, and now all of a sudden the exchange rate changes, and now $1 buys 10 tokens, does your dollar buy more or less than it used to? Your dollar buys more. So what would happen to your demand for games? It would increase. The dollar has appreciated. That means the dollar buys more. In this case, what it's buying is tokens, and it buys more tokens. It's now only 10 cents for each token. Now, if exchange rates changed again and $1 buys 2 tokens, Now, do you want to play as many games? Probably not. Your demand for tokens would decrease because now they're all individually more expensive. So other currencies, global currencies, function the same way. And how much $1 buys in a foreign currency impacts Americans' desires to buy goods and services from that country or to buy assets from that country. So how do exchange rates work? Anything that you want to buy in a foreign country, goods and services or assets, you're going to need to pay for it in that country's currency. Even if you buy things online, sometimes websites, if the website is in another country, they will convert your currency into that currency. And they'll do it digitally, but they often will still charge you a conversion fee. So no matter how the good, service, or asset is purchased, it's purchased in the currency of the country that controls it. So let's say you're going to Mexico and you want to buy a t-shirt. So if you see the price is 187.5 Mexican pesos. First of all, it's very hard to picture in your head how much that's worth in US dollars. So we're going to learn how to do that. But you also normally can't pay in US dollars. You're going to have to take your money and convert them into pesos in order to buy this good that is priced in pesos. So you could go to a bank and convert it. There's also kiosks, sometimes in malls or in airports. Oftentimes this can be converted online if you're paying with your credit card. But no matter how you convert your money, you're still converting dollars into pesos, and you will pay the current price for that conversion, and that's set by supply and demand of the foreign exchange market. Because currency is traded all over the world, and a lot of it is traded digitally, exchange rates also change constantly. So at any given time, you could look up what one US dollar will buy in any currency around the world. So we can see here, for example, in April 30th, one US dollar bought 94 yen and 0.75 euros. And then you can see 1 yen, what it buys in the other goods. So you can really do any changes to these ratios. And this doesn't really tell us, oh, things are expensive in Japan where the yen is. Not necessarily. All we know is that if we are going to Japan and we need yen, how many yen can we buy for 1 US dollar? So that's how exchange rates are used. If you're in a place, let's say Japan, and you wanted to figure out a price, you could divide it by 94 in order to figure out the relative cost in US dollars. What's unique about the Forex model is that we're used to learning about this category of things shifts supply, and this different category of things shifts demand. In Forex, there isn't that clear distinction. Something might occur that makes Americans want to buy European goods. So in that case, the demand for the euro will increase. And in order to get euros, we have to give US dollars. So the supply of US dollars will increase. So you can see how the same situation, if we want more euros, we have to give more US dollars. It shifted demand for one currency and supply for another. People can only control supply of their own currency and demand for someone else's currency. Now this could work in the other way around. Maybe something happens now and we don't want to buy as many goods in Europe. That would decrease demand for the euro and decrease supply of the US dollar. So the point is, there's nothing that just shifts supply or just shifts demand. Now, an interesting thing that can sometimes help you understand Forex is that if you need or if you want to buy something in Europe, you're technically purchasing euros. And that's why it still counts as a market where things are bought and sold. That when you're giving dollars in exchange for euros, you're buying this currency. So that's why the Forex model is technically this economic purchase and trade, supply and demand, same rules apply, where a higher price of something, you want it less. So back to our example before, where we're in Mexico and we want to buy a t-shirt that costs 187.5 pesos. First of all, we need to know what the current exchange rate is. So we're going to look at the exchange rate at 1 month and then the exchange rate later to see how the value has changed. So in April, 12.1 pesos bought $1 US. So that is the exchange rate. Now, if you wanted to convert that to the other way around and you only had 1 peso, how much American currency would you get? This is really a ratio, so you can divide both sides by 12.1 to get 1 peso. And then for US dollars, how many decimals do you think you're going to do? We're talking about money, so 2 decimals. So 1 peso buys you 8 cents in US dollars. So there we have the exchange rate. Now for the individual t-shirt, if you're curious how much that 187.5 pesos is valued in US dollars, you take the price, you divide it by the exchange rate, and you can see here that pesos divided by pesos, those will cancel out, and what we're going to be left with is the price in dollars. So 187.5 divided by 12.1, that t-shirt is worth $15.50. Now that can help you decide, is that a fair price? Do I want the t-shirt at that value? Whereas 187.5, if you're not used to buying things in pesos, might seem abstract and you have no concept if that's a fair price or not. If you recall, in April, the exchange rate was $1 for 12.1 pesos. In June now, it's $1 buys 12.5 pesos. So you can see how the dollar buys slightly more than it did before. So that's going to be called appreciation when the dollar buys more. So if you're in Mexico and you wanted to convert at that point, still 1 divided by 12.5 will tell us how much 1 peso buys. It's still 8 cents. The reason why is that when we're rounding here, we're going to lose a little bit of value. But when we go the other way around and something more expensive like this t-shirt, we will see that price difference. So the t-shirt price hasn't changed because somebody who runs a store in Mexico isn't going to constantly be changing their prices based on exchange rates because every different currency is going to have different exchange rates. So same t-shirt price, but now we're dividing by the new exchange rate. So 187.5 divided by 12.5. In June, that t-shirt costs $15. So see how if the dollar buys more pesos, that means that this t-shirt is slightly more affordable than it would have been because the dollar is stronger. It goes a little bit further. I was talking last slide about the fact that the dollar has appreciated. So let's get into more depth about what that actually means. So the dollar is more expensive in terms of how many pesos it takes to buy a dollar in June than it was in April. So if the dollar buys more of a foreign currency, then it has appreciated against the currency. So you can see here that if it buys more, it appreciated, but the other good in comparison will depreciate. So the peso here in April, 187.5 pesos is valued at $15.50. 2 months later, the same amount of pesos is valued at $15. So you can see how the value of the peso is declining, and that is called depreciating. The same amount of pesos bought fewer dollars. So there's always going to be one currency going up and one going down. If the dollar buys fewer euros, for example, it would depreciate against the euro, but that would mean that the euro would buy more dollars, so it would appreciate against the US dollar. Now, we don't know if the dollar appreciated against every single currency around the world. There's too many currencies and too many global and regional economies for that sort of thing to be true. So if you say the dollar appreciated, you have to say compared to what, and specify which currency it now buys more of. And then that currency, in reverse, should depreciate against the dollar. Now let's focus more on how we actually draw these foreign exchange market models and how we determine the equilibrium exchange rate. The price of a currency is the exchange rate, so that's important to know. So the price of the US dollar, for example, is the exchange rate in some foreign currency. And it might be one number in one currency and one in the other, but that's still the price of a currency. What will it take to buy it? And that is set by supply and demand. If I want pesos, I demand them. You demand other people's currency. In order to get them, you supply your own currency. So if our demand increases for a currency, then we must supply more of our own currency to get them. When you're drawing and labeling Forex models, there will always be two different currencies on the model. So you can see here where it says exchange rate, we have pesos per dollar. Now the question is this drawing a drawing for pesos or is it a drawing for dollars? You look at the supply and demand axes. So if it's supply of dollars and demand for dollars, then that means this is a Forex model for dollars. The quantity is also in dollars. What is the price of dollars? It's how many pesos it takes to buy them. So in this case, the equilibrium price is 12.5 pesos. If we were drawing the opposite model, we would have supply of pesos, demand of pesos, quantity of pesos. The price would be in dollars, and the exchange rate would be dollars per peso. So here's how we learn how to draw it. First of all, you have to decide which currency are you drawing this for. If we're showing supply of one and demand of the other, you would have to draw two different Forex models. So this one is for the US dollar, so that's why we write US dollar for supply. Now remember, you could shorten this supply of US dollars, USD. So that's as short as it gets. Demand is also for US dollars. And the quantity is in US dollars. For the subpoint at the bottom, a Q or a QE is totally fine. So for the y-axis, we're going to always have the exchange rate. And we have this trick, in case you're wondering, do you write dollars per peso or pesos by dollar? Per dollar, that can confuse people. So there's this mnemonic trick, what goes below, goes below. So the fact that in the quantity line, we're talking about dollars, that's what goes below. So it also goes below here, pesos per dollar. And then finally, the price of the good that you're doing supply and demand for is in some other currency. In this case, we know the exchange rate, so we can put a number. If we didn't know it, then you would just write the name of the currency to specify that the price will be in pesos at equilibrium. So that's how you would set it up if you didn't know some specific value. The demand curve for every model is always downward sloping, but let's go through why it makes sense in the Forex model. So if you're drawing supply and demand of the US dollar, DUSD. So first of all, the price of it is in how many pesos it takes to purchase $1. And as the price of the dollar falls, that means the number of pesos it takes to buy $1 also falls. So the dollar depreciates. If the dollar depreciates, that means the other good, the peso, must appreciate. So people in that other country Mexico, will find American goods to be comparatively less expensive. Their peso now buys more. So the quantity of American products that they want to buy will go up. So you can see here, as we have it move along the curve, the quantity of dollars increases because they want to buy more products if their peso buys more dollars in our economy. Supply is usually upward sloping if there is a profit incentive, and here there is, because the people that demanded the currency, remember, are people in other countries. So that's how we were talking about Mexicans buying American products when we talked about demand for the currency. Supply for the currency is set by your own people. You can supply your own currency. So as the price goes up, move along the curve here, the dollar appreciates. We can see the price of it is rising, so $1 is worth more pesos. Consumers in the US, because it applies from their perspective, if the dollar appreciates, it's stronger, then Mexican products seem comparatively cheaper. So you'll want to buy more products in a foreign country, so the quantity of the dollars that we will supply on this international market will increase. And then, of course, the definition of equilibrium is where supply is equaling demand. So at 12.5 pesos per dollar, the quantity of dollars that demanded will be equal to the quantity of dollars supplied. By the way, if you wanted to convert this drawing into pesos, of course you'd label it supply of peso, demand of peso, quantity of peso. The exchange rate would change, but the number would have to change too. You couldn't leave that 12.5 on the side. You would need to divide 1 divided by 12.5 to figure out how many US dollars purchases 1 peso. Remember, there is no distinction between supply shifters and demand shifters for the foreign exchange models. Something that increases your demand in a foreign currency would increase supply in your own currency because you need to supply more of yours to get more of someone else's. Now, one shift will be of one currency and the other shift will be in a different currency. So here are our shifters. The first one is speculation. We'll learn what that means. It's about investing in currencies. And that's all about expected changes in exchange rates. Do I expect the value of the yen to go up, for example? The next category is all about real income. And that's if a country that we are a trading partner with becomes wealthier, the real income level rises, and they're going to purchase more products at home and abroad. Relative interest rates are about the idea that investors can save their money in assets in different countries around the world. And so if they're going to earn a higher interest rate elsewhere compared to at home, the relative interest rate is higher somewhere else, they're going to want to invest in that country, so they will demand that country's currency to buy the asset. Tastes and preferences are all about popularity of foreign goods. Sometimes things happen that make a certain country's products more popular or less popular, and that can shift to the demand of the currency. And then, therefore, supply of your currency. If you're buying fewer products made in Cuba, then you would supply fewer American dollars to buy those products. And then the relative inflation rate is all about the idea that exchange rates are just one thing. I know how many pesos my dollar buys, but I don't know if there's inflation in Mexico. Because if prices are going up rapidly, then yes, my dollar might buy so many pesos today, but that might change during the course of my trip, and that will impact the value of how much I can buy elsewhere too. When you think of speculation, you want to think about investments. So you might not think of currency as something to invest in, but lots of people do. There's nothing that stops you from going out and converting your life savings to a foreign currency. Maybe you think that the rupee in India is going to go up in value. So if you think a currency will appreciate, the value will go up, oftentimes they convert a large amount of their money into that currency. And the hope is when that currency does appreciate, they can then exchange their money back. So I can take maybe $1,000 US dollars, convert them into rupees if I think the Indian rupee will go up in value. And if it does, then I can convert those rupees back and I'll get more money because the rupee will be trading at a higher value when I sell it back. Then I'll make a profit. Now, this affects the demand for that currency because I want to buy that currency, assuming it will be more valuable. So if I demand more rupees, I will supply more US dollars to get those goods. What's interesting is that when you do convert currencies, at any point in the game, let's say I'm planning a trip to India and I'll need to convert my dollars, you tend to pay fees for the service of the people trading currencies for you. Because honestly, if someone is set up with a kiosk in the mall or at a bank and they've had to stockpile a lot of a currency in order for when you come by and you want this much in that currency, they have to have it there waiting. So you're always going to pay for the service of the exchange. So this is speculation is I assume that I will make more money beyond what I pay in fees. That this other currency will go up in value so much that I will make a profit. Of course, this is a guess like any other investment, but they look at trends, they look at where other countries are in their business cycles, are they going through an inflationary period? And investors make guesses about which currencies will go up in value, and they start to stockpile, they buy up a lot of that currency in the hopes to make a profit. Real income means that a country that we trade with might become wealthier overall. If that's true, they'll buy more goods made in their own country, domestically produced goods, but if they have a lot of extra money, they'll buy more imports too. They'll buy more things from their trading partners. So a wealthy country will have an increase in demand for other currencies because they want to buy more products now they're doing better financially. So when they demand more of other currencies, they will supply more of their own. This also can go in the opposite direction. So let's say the real income level in Canada falls. Canadians use a dollar as well. It's different than the US dollar. But if people in Canada are having a recession and they all have less money, then that might mean that they buy fewer Canadian products, but also fewer American products. So they would demand fewer US dollars, and they would supply fewer Canadian dollars as well if their real income decreased. Now we have a practice problem, practicing real income. Let's say the real income in Mexico increases. So the Mexican residents will buy more or fewer goods and services from USA. We can assume that they will buy more since they have more income. So if they're going to buy more American products to import from us, does that affect the demand of the supply for the US dollar? This is people in another country, so they are demanding US dollars to buy those imports. And if the demand goes up, will that appreciate or depreciate the US dollar? It will appreciate it. A rise in demand increases the cost of the US dollar. Now, so they're demanding our currency. What happens to the peso? Are they supplying or demanding the peso? They are supplying their currency. So they're demanding more US dollars and supplying more pesos in order to get those additional dollars. If they supply more pesos and supply shifts right, does the peso appreciate or depreciate? It depreciates. And remember, there's always a trade-off. If one currency is appreciating, the other one is depreciating. Here for relative interest rates, it's all about comparing the interest rates in one country to another. And we can look at this model and see that we're comparing yen, which is Japan, and the US dollar. So if the real interest rate in the US increases, first of all, which model would show us the real interest rate? That's the loanable funds model. So if the US real interest rate is higher than the Japanese real interest rate, Japanese investors who are buying assets know they're going to earn interest, and they're going to want to earn interest that's as high as possible. So if the interest rates are higher in America, then Japanese people will want American assets. Does that sound like supply or demand of the US dollar? Other countries demand our currency. And if they want to buy our assets, if they want to buy a bond and earn that interest rate, the demand for the US dollar will increase. It will be a right shift. And we will label that demand of US dollar too. But before I label the rest of it, we're actually not quite done yet. So demand is from people in other countries. Supply is from your own country. So if interest rates are higher in America compared to Japan, that's why they're relative, because we're comparing them, residents of the US will decide, you know what, I don't actually want to have my assets in Japan where they're earning less interest. I'm going to keep my money at home. So the supply of the US dollar in these international markets will decrease, because instead of keeping their money in a foreign country, they're going to decide to keep their money at home. So the supply of the US dollar shifts to the left. So now I can see my E2. There's not quite room there, so I'll put yen 2 over here. All right. Now, both of these shifts appreciate the US dollar. And by the way we can tell is that this side over here is always price, right? This axis is always about the price. The price of the US dollar is in yen, but the price went up. So if the price of the dollar goes up, it has appreciated. People often get this messed up, so I want you to see the difference. Just because it says yen and yen arrow does not mean the yen appreciated. Actually, the yen depreciated, because if the US dollar appreciated, the yen must depreciate. What we're seeing is that the price of dollars in yen went up. The currency itself doesn't actually matter. The model is for dollars, the price went up, the dollar appreciated. So the point of all of this is not only did the fact that US has higher interest rates leads to the appreciation of the US dollar, but also I want you to see that this is the only double shifter that we have. Usually we shift demand of one currency and supply of a different currency. Relative interest rates shift supply and demand of the country that has the higher real interest rate. Both of them shift, and they shift the same. Well, they shift in different directions, but the effect of both shifts is to appreciate the US dollar. Tastes and preferences can also affect demand and supply for currencies. Let's say products in Canada become more popular than they were in the past. That'll increase demand for the Canadian dollar and increase supply of the US dollar in order to pay for those goods. Inversely, if demand and taste for those products decreased, demand for the Canadian dollar would decrease, supply of the US dollar would decrease because they would be less interested in buying those products. If one certain country is very trendy all of a sudden, that'll increase demand for that country's currency and increase supply of the country that now desires their products. So far we've talked about exchange rates and how they affect the relative prices. That if your dollar buys more of a foreign currency, then that makes those prices cheaper. But there's another variable at play, and that's what's happening to the inflation rate in that country. Because your dollar can buy so much of that currency, but if that currency is going through rapid inflation, That's a whole different ballgame. So we're going to have to figure out the real exchange rate. Remember, anytime you convert a nominal value into a value that is adjusted to show changes in price level, that's the real value. If we wanted to figure out about how inflation is impacting the exchange rate between the pesos and the dollar, we would need to figure out the price levels, which will show us the relative inflation rates of each country. So PUS stands for the aggregate price level in the US, and PMEX stands for the aggregate price level in Mexico. So the real exchange rate is the pesos per dollar, the normal exchange rate, times the price level of the US divided by the price level in Mexico. So sometimes the original rate that we were given would be called the nominal exchange rate. And remember, nominal is always the default. So if it doesn't specify if it's nominal or real, that means it's always nominal. Real, they've gone through the effort of converting the number, so they will always tell you if it's the real exchange rate. Let's look at how these exchange rates work. So in the first example, we're going to assume that there is no difference in the aggregate price levels. If you remember this whole base year price, base year is the concept that year is the year that we're comparing all other price changes to. And the price level in the base year is always 100. So remember, if the next year is 107, that means we have a 7% inflation rate. It went up 7% from 100. If the price level of the next year is 82, then we had an 18% deflation rate. It went down 18 from the base year. So if there's no inflation, the price level in both countries will be 100. So the real exchange rate would be the nominal rate, 12.5 pesos per dollar, times the price level in each country. They will cancel each other out. It'll be 12.5 again, which makes sense that nominal would equal real if we didn't have inflation. In example 2, we're going to assume that the Mexican economy has a 10% inflation rate. So if we're adding 10% to 100, it'll just make the price level 110. So in that case, it would be 12.5 pesos per dollar times the price level in the US, 100, divided by the price level in Mexico showing inflation, 110. Now the exchange rate has changed. So the real exchange rate is different from the nominal exchange rate. So in real terms, that nominal rate didn't change, but it means that each dollar buys fewer pesos if there's inflation in Mexico. So it might look like it's 12.5, but when you adjust for inflation, it's really 11.4. So the real rate is more accurate when it shows you what your money actually buys in that country. The current account, which includes the sale and purchase of all exports and imports, cares a lot more about the real exchange rate, not the nominal exchange rate. So in order to figure out how a currency will impact goods and services, we need the real exchange rate. We started these notes talking about how the foreign exchange model relates back to current accounts and capital and financial accounts and the balance of payments. So let's talk about how Mexico and the United States, because those are the two countries involved in this model, would be related here. So let's say that Mexican consumers are going to buy financial investments. So financial investments, we're talking about assets, stocks, bonds, CDs, maybe they're buying corporations. Would that be part of CA or CFA? So these assets, these investments, are going to be part of the capital and financial account. And they might decide to buy more assets in America for a variety of reasons. Maybe there's an increase in the real income level in Mexico, and so they are able to buy more of these assets. Or maybe there's higher interest rates relatively in the US, meaning that they're higher in the US compared to Mexico. And that also would make Mexicans decide to buy more assets if they're going to earn a higher interest rate. So if they're buying an American investment, they will demand dollars. So we can see here, this is the model for US dollars, and the demand for US dollars has increased as these Mexicans are using dollars to buy assets, all of which goes into the capital and financial account. So the CFA has increased. Money's coming in. Perhaps we even have a surplus in that account. The increase in Mexicans buying financial assets in America increased demand for the US dollar. So that's what caused the shift that we're starting with. When the demand shift occurred, that actually means that the price of dollars, in terms of how many pesos you need, has gone up. When the price of dollars goes up, that means that the dollar has appreciated. So in terms of goods and services, if the dollar is appreciated compared to the peso, that means that Americans are now able to buy more products from Mexico at a cheaper price. A strong dollar will buy more Mexican goods. So we had an increase in the amount of assets and the amount flowing into that category of balance of payments, but goods and services, exports and imports are all part of the current account, CA. And because Americans are deciding to use this strong dollar to buy more Mexican products, that payment's going to foreigners to Mexico. So money is leaving the current account, it's decreasing overall. Here we have the balance. The capital and financial account increased. Money came into that account as more Mexicans bought financial assets from America. But money flowed out of the current accounts as more Americans used their strong dollar to buy goods and services in Mexico. So we saw that the inverse of CFA equals CA. If one's going up, the other one's supposed to be going down to an equal amount. And we can see here that the increase in demand for US dollars occurred because Mexicans wanted to buy our assets. Now the quantity that occurred is equal to the change in the quantity supplied. Remember how you would word this, that if demand shifts right, demand increased, and the quantity supplied increased because that was a move along the curve. So that means that the amount of dollars demanded by these Mexican investors equals the quantity of the dollars supplied by American shoppers who would bring their money over to convert them to pesos to buy Mexican products. You do have to be able to differentiate when any currency is appreciating or depreciating, what effect that's going to have on the exports and imports. So in this case, if the dollar can buy more of a rupee, the Indian currency, then the dollar has appreciated in value compared to the rupee. One can also say that the dollar is stronger than the rupee. Now, if the dollar buys more, that means that comparatively the rupee buys less. It has depreciated. So from the American point of view, if the dollar is strong and it appreciates, will it export or import more? Exports, remember, are American products being sold to the world, and imports are Americans buying things from other countries. So if the dollar is strong, then we are able to buy more from other countries. Our imports will go up, but it also means that our products are comparatively more expensive to others. So exports fall when the dollar is strong and imports rise. So like most things, people might assume that it's a good thing universally if the dollar is strong. Well, not necessarily. Not if you run a business that depends on exports, selling products overseas. In that case, a strong dollar would be bad for your business. So this is like most things, it depends what perspective you're looking at. And vice versa. When a dollar buys less of a foreign currency, that means the dollar has depreciated. It's decreased in the amount that it buys, or it is comparatively weaker than the other currency. So if the dollar is weak, that means American goods are more affordable to other countries. So if the currency depreciates, our exports will rise. People in other countries like when the dollar is weak because they can now afford more of our products, whereas imports will fall because a weak dollar can't afford as much of another currency if you have to convert your dollar into other currencies to buy those foreign products. Oftentimes, the appreciation or depreciation of a currency can be caused when people are interested in buying more or fewer American assets. If they want to buy more of our assets, the demand of our currency increases and the currency itself will appreciate in value. That leads to a change in the amount of goods and services, exports, and imports that can occur in this country. So as you saw, if the amount of assets goes up, so that's the beginning part here, we have an increase in the amount of money coming in there. That increases demand of the currency, appreciates the currency. But that also means that the dollar is strong. So the amount of exports of people in other countries buying our stuff decreases. So the current account decreases. And this should be an exactly offset. They should equal each other. And then likewise, if we have a decrease in capital flows, if people send less money into America to buy fewer of our assets, CFA, the capital and financial account, would have less money coming in. That would decrease the demand for our dollars. That would depreciate the currency or make it weaker. And if that happened, then people in other countries can buy more of our products, which is going to have money coming in to our current accounts. There'll be an increase in our net exports. And remember that equation for net exports is just exports minus imports. Purchasing power parity is about the idea that what exchange rate would make it so that two market baskets would cost the exact same amount. So the idea is it's not going to be $100 and 100 yen. But when you convert each currency into $100, does $100 in America buy the same amount as if I converted that $100 into yen? If so, then the nominal exchange rates are equal with each other. If you look at the word parity, think about things that are on par. At a golf course, if the hole has two par, that means that we expect you to get two holes. If you get two shots on this hole, then you broke even. So that's all equalizing each other. So purchasing power parity is when exchange rates are actually equal for both countries, and your dollar or whatever currency will buy the same amount in both places. So to look at actual numerical examples of purchasing power parity, it is quite possible that $100 in the United States could buy 1,000 pesos worth of products in America. If those baskets of goods and services are identical, then we have parity. And we can actually convert that down into an exchange rate, where if we wanted to figure out $1 US, we could divide both sides by 100 and see that purchasing power parity would be 10 pesos equals $1 US, and the market basket would be equal. If the exchange rate is something more or less than 10 pesos per US dollar, then those two countries have not reached the purchasing power parity. If exchange rates are set by supply and demand, why wouldn't two countries have purchasing power parity? Shouldn't supply and demand move to the point where things equalize and we hit parity? Well, the idea is that there are sometimes things that aren't equal between nations. For example, inflation rates. One nation might be experiencing more inflation than another, which would be reflected in the real exchange rate, but the nominal exchange rates would not match up. Also, those two different countries might have different rates of development. As you'll see in Unit 6, developing nations receive more capital inflows. Oftentimes, developing nations have more things that people can invest in. They have a lot of new infrastructure that people can invest, and they feel like that there's a high risk but a high reward on these loans. So people often send capital flows to developing nations, whereas developed nations often don't have those high rates of growth and they don't need as much foreign money to flow in. Capital inflows are going to be buying those foreign assets to invest in those projects. So that'll affect the demand of the currency if people in other places demand the currency in order to buy those assets to invest in the developing nation.